Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, June 14th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line, and from this podcast. Just this week, in fact, I wrote to my paid subscribers about a few hedging strategies that I've been employing in my portfolio over the past 12 to 15 months. We discussed how these hedges are doing. I identified some changes that I plan to make to these hedges, as well as my next steps in this regard. And oh, by the way, along the way, over the past 2 to 3 months, we've also identified 3 stocks that are of high interest to us going into the next earnings season that's going to start in the middle of July. So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. Now, a few quick PSAs. First of all, this podcast is also available in YouTube format. If you search for Market Whispers by Beachman or Invest with Beachman on YouTube, you should be able to find my channel out there. The transcript for this podcast is also now available for reading on the website for this episode, on the Substack website. It is currently only available on the website, but it is likely to come to the app soon. And the third PSA is, please take a few seconds to like this episode or drop a comment. I'm personally too old to care about likes and thumbs ups, but the algorithms on Substack and YouTube, well, they do care about these likes and comments. It helps with increasing readership engagement so that more people can find my writings, find this podcast, as well as join the growing Beachman community. Now on to the meat of this episode. Well, this week we're going to cover the current state of the markets, what's the word on the street. We're going to cover what's coming up in the markets over the next 2 weeks, and we'll wrap up with some final thoughts. But our main topic for this week is about whether Apple is an interesting investment opportunity right now. We will discuss why Apple's AI-related announcements that we got this week, why they were so important to the markets, to consumers, as well as to investors. So let's dive in. Well, the current state of the markets continue to be upbeat. For the week, the Dow Jones lost 0.5%, while the S&P 500 gained more than 1.5%, and the Nasdaq logged on more than 3% just this week. So far for the year, the Dow Jones is up over 2.4%. The S&P 500 is up almost 14% for the year, and the Nasdaq is leading the three of them, up almost 18% for the year. Several indexes continue to log new all-time highs, continued this week as well. This is kind of becoming commonplace now. There is a 3-way horse race going on between Apple and Nvidia and Microsoft in terms of who has the highest market cap in the world. All 3 of them are nipping at each other's heels. Last week, Nvidia made a big move up. And this week, Apple said, well, hold my beer, and Apple zoomed higher. Now, there's no shortage of data or signals or charts that tell us about how one-sided this market has been and still is today. While the S&P 500 is above its 50-day moving average, only 43% of its component stocks are above their own respective 50-day moving averages. This is the 6th lowest such reading since 1990, and similar low readings like this have typically preceded large market drops or bubble bursts. Only a handful of megacaps are dominating the leaderboard, as we know, while the rest of the market is participating in the bull market in kind of a smaller way. The gap between the winners and the losers is as high as it has ever been. If we index the top 10 stocks in the S&P 500 against the bottom 490 stocks in the index to see just how big the spread is, the difference in performance between these two cohorts is worth 2,100 S&P 500 points. And today, the S&P 500 is at about 5,400 points. So the difference between the top performing stocks and the bottom 490 stocks in the index is about 2,100 points. That's a massive divergence there. There's so much liquidity in markets today, and most of it is actually headed towards risky assets that are still working. Risky assets like mega caps, AI stocks, semiconductor stocks, and even some cryptocurrencies. In fact, there's so much money sloshing around in the market these days that, as per Wall Street Journal, hedge funds are now investing in other hedge funds. I mean, think about the risky profile that situation brings to the table. Per Yardini, the S&P 500's forward PE, the price to earnings ratio for the S&P 500, the S&P 500's forward PE is now almost 21 points. The historical PE is at 18, so it's about 20-25% overvalued today as compared to its historical rate. So the S&P 500's forward PE is 21, and if you take out the mega cap 8 stocks from that, the S&P 500's or the S&P 492's PE is only 18 points. The mega cap 8 stocks themselves, if you just look at those 8 stocks, their forward PE is at 28 points. If you look at mid caps and small caps, they are way behind. They are right now fairly undervalued. Mid caps have a PE at 15 and small caps have a PE of 14. So they seem relatively undervalued and relatively cheap. The Wall Street Journal also told us that it's easy to look at what they call the piddling daily moves in the S&P 500 and think that the market has been so boring recently. I mean, there hasn't been a 2% move since February. And the VIX, which is the gauge of volatility in the markets, has been very, very subdued in the low teens. Under the surface, however, under this calm surface of the markets, there's furious paddling going on amongst individual stocks. Only once in the past 25 years have we seen these kind of swings among individual stocks while the overall market is staying so placid. I mean, one way to think about it is, at a high level, investors look at the index and say, there's not much going on. But when they look at individual stocks, when they look at particular stocks or sectors, then the divergence between the haves and the have-nots becomes a lot more clearer. And in this case, the haves being AI stocks, mega cap stocks, and semiconductor stocks, for example. Semiconductors as a sector are up 60% just year to date. Just 60% year to date, and we're not even through the middle of the year. So the result is that we have far more stocks today with plus or minus 10% swings in a one-day time frame over the past 3 months as compared to any other time in the history of the market. And the market is barely budging 0.5% here and there. And this is exactly why shorting this market, if we feel like the market's going to go down, this is exactly why I believe that shorting this market at the index level is very risky. So what's the word on the street this week? Well, in this segment, we'll cover some major important market updates and events that we got this week. We'll also cover some key macro updates that we got this week, and we got a bunch of them this week. And then we'll also discuss some important business updates that investors should know about. So let's dive in. Well, first of all, we have to talk about the CPI retail inflation report that came out this week for the month of May. In May, CPI or retail inflation grew 3.3% year over year. And this was lower than last month's reading, and it was also lower than what Wall Street was expecting. If we look at just core CPI, that also came in at 3.4% year over year. Again, that was lower than last month and lower than what Wall Street was expecting. Both these readings came in lower than expectations as well as lower than their previous months. And these were the smallest increases that we've seen in CPI since April of 2021, going back all the way to 2 years, 3 years ago. The May CPI report is the fourth report in the year that has shown a decline in average grocery prices. And this is something that is very, very important to consumers and consumer sentiment. You have to go back to February 2004 to see the same degree of core goods deflation that we had last month in the month of May. Average gas prices are at their lowest level so far, their lowest level since June of 2021. We saw a 3.6% decline in gasoline prices in May. Food, like I said, had their smallest increase since 2020. Restaurants had their smallest increase since 2021. Even commodities reported their smallest increase since 2004. And new vehicles, this was one of the big inflation jump categories that we've seen since the beginning of this year. New vehicles saw their smallest increase since 2018. Overall, like I've said before, overall the inflation trend continues to trend lower. It implies that we got some hot inflation numbers earlier this year, but it implies that those were just kind of one-off noises rather than an actual trend-related signal. The gradual disinflation trend is reasserting itself and will continue to do so through the remainder of the summer. Now, if we look at CPI or inflation readings for the past, say, 3 to 4 quarters, there were really two big cost categories that were holding up the CPI: housing and auto insurance. Now, with this month's report, with the month of May report, auto insurance costs seems to have peaked and are now moving lower. Thank you, Jesus. And now we have to see housing costs break lower. So that is going to be the next thing that markets are going to be looking at when we get the June CPI inflation report. Here's another interesting stat, by the way. Since 1967, there have been 689 CPI prints, and only 31 times has the core CPI printed negative month over month. This week, we got one of those 31 negative core CPI prints, month over month prints. We also got the PPI, or the wholesale inflation report, for the month of May this week. And as expected, those readings also continue to trend lower. PPI year over year was 2.24%, lower than last month. It was also lower than what Wall Street was expecting. Core PPI was down to 3.4% year over year, again lower than last month and lower than what Wall Street was expecting. Another reading we got, another macro report we got this week, was the NFIB Small Business Index report. Now remember, this is one of the leading macro reports that I follow, macro indicators that I follow. And that's because small businesses in the US employ almost 70% of all Americans. So if small businesses are hurting, they will likely take down jobs, they will likely hire less, they will likely pay less, and that will take down the US economy. Well, in the month of May, small business optimism rose to 90.5 points. This was higher than the previous month, and this was higher than expected. So again, this is another macro reading that is moving in the right direction. This was the highest reading that we got in this index all year this year in 2024. Small businesses could be turning a corner. We'll have to see in terms of their forward outlook. Hiring and capex spending plans improved. Inflation and high interest rates are still the most important issues for these small business owners. So they will continue to be worried about how inflation is trending and the fact that we have higher for longer interest rates in markets today. But it seems like we're getting a little bit of optimism from the small business community, and we will like to see that continue when we get the June report. This week, the US Feds held their June meeting. They left interest rates unchanged at the 5.25 to 5.5% short-term interest rate. They updated their dot plot that shows inflation and rate expectations for the next 2 to 3 years. Now, the new dot plot shows that US Feds are expecting only one rate cut in 2024. In fact, the dots moved higher in this latest dot plot as compared to the previous one we got in March. This shows that the Feds expect rates to be higher for longer, not only in 24, but also likely in 25. Fed Chair Powell acknowledged that the new dot plot was conservative. He acknowledged that they could change their minds in the future based on what future macro reports show. The committee continues to look for more proof, more sustainable proof, that inflation is truly on its way down to their 2% target. I continue to believe that we're going to get our first rate cut in the month of July. Their meeting is at the end of July. And then we will get a second rate cut possibly in September. This week, we also learned that companies continue to strongly buy back their shares because we are now out of the Q1 earnings blackout period. Remember, companies are not allowed to trade their shares a few weeks before the Q1 or the quarterly earnings season starts. And as soon as they publish their earnings report, they're allowed to buy back their shares. So we're starting to see some very strong corporate share buyback activity in the markets today. And this could be one of the reasons why shares for certain stocks have been supported, well supported, and continue to rise over the last couple of weeks. In May, US companies announced a record $201 billion in share repurchase plans. Apple itself announced a $110 billion buyback program for this year. This marked a 41% increase from last year in terms of share buyback programs, and it is the fifth highest on record for any month in the history of the US. This surge in corporate buybacks reflects confidence in both the earnings power that companies feel that they will see over the next 3 to 4 quarters, confidence in their ability to generate cash flows, confidence in their operational stability. And this, like I said, has been providing a boost to stocks, even though we expect GDP growth to be lower over the next 3 quarters. The January to May period saw the second highest total of buyback announcements ever, with the number of companies participating being the second most on record in the history of the markets. Goldman Sachs disclosed just this week that their buyback trading desk is currently running at about 160% of their year-to-date daily average volume as compared to their previous averages. This is by far the busiest that their trading desk has ever been in recent times. We also learned this week that there seems to be a pricing war among China's major cloud platforms. We learned that from a Substack writer called Kevin Xu, who reports regularly on technology and China-related topics. So Kevin told us that Alibaba Cloud, the market leader in China, they fired the first shot in March by cutting prices of over 100 different cloud services by up to 55% for their China customers. A month later, they expanded those same cuts to all of their data centers, including customers outside China. And then in May, they cut prices again, this time for their in-house foundation AI model called Qwen by as much as 97%. Now, as soon as Alibaba executed these price changes, this was immediately followed by similar cloud-related service price cuts by their competitors like Tencent and Baidu, JD, and ByteDance. So what I find interesting in this is that we are not seeing this kind of pricing war in the US among US-based cloud providers. US-based hyperscalers are not really cutting their prices to bring in more cloud. In fact, they're seeing higher interest in digitization, higher interest in adopting cloud-based platforms, and of course, higher interest in using and adopting AI-related cloud-based infrastructure. From App Insights, another Substack that I follow, we learned that travel could be on the cusp of a new era of tech disruption. The global online travel market could reach $1.5 trillion in size by the year 2030, growing at a compounded annual growth rate of about 13%. Of all the industries that are reliant on agents to support customers, tourism is ripe for AI disruption. Online travel agencies like Expedia, Google Flights, or Kayak could start using AI agents sooner rather than later to better serve travelers who go to their website. Glenn Fogel, the CEO of Booking Holdings, he envisions a future where AI-powered connected trips seamlessly orchestrate every aspect of a traveler's journey, from bookings to recommendations to real-time problem solving while the traveler is actually traveling. Now let's get into the main topic for today. Today we're going to talk about the fact that Apple this week kicked off a new AI product cycle for the consumer. And we're going to take a look at these developments from the lens of an investor. Now, when it comes to Apple, a few things are already clear. It is one of the largest, most profitable, and well-run companies in the world, and it plays a key role in our daily lives via its products and services. When Apple says or does something, the world pays attention. Everybody expects them to succeed, consumers get excited, and competitors try to emulate them. But in the AI space, Apple has been lagging against its competition for many months now, until possibly this week. Apple made some long-awaited and important AI product announcements at their WWDC Worldwide Developer Conference this week, and it was all about artificial intelligence. Now, right off, Apple is rebranding artificial intelligence, well, as they would do. They're Apple, of course. Apple is rebranding artificial intelligence as Apple Intelligence. AI very nicely, coincidentally, works out as they rebranded to call it Apple Intelligence. Now, there are 2.2 billion Apple devices in use around the world today. And starting in September, all of these devices can upgrade to iOS 18, which is a newer operating system. For devices that have the latest A17 Apple chip or any of their M series chips, the new iOS operating system will allow that device to use a series of game-changing AI capabilities. Apple Intelligence will learn about how we use our device on a regular basis, who are the important people in our lives, what daily and regular activities do we do in our day-to-day lives, where do we go often, what are the places we typically visit and how regularly we visit them. And based on all of that personal context that Apple Intelligence will learn about us on our device, Apple Intelligence will apparently help us to become more productive in terms of how we use AI to actually use and control these devices that we have on our person. Without, and this is important, Apple Intelligence will do this without compromising our security, without sending or storing our personal data onto some back-end data center in the cloud, without sending or storing our data in the cloud without our permission. And this latter part seems to be a game changer in my mind. Now, Apple is using SLMs, or small language models, that run on our device to respond to our AI-driven queries and our needs. It also gives the user the option to use OpenAI's ChatGPT for free in case the user wants to do so. Apple promises that soon it will offer access to other AI models, like Google's Gemini, and perhaps even Apple's new LLM once they develop and launch that. And this will provide the user much more flexibility and choices in terms of which AI model they want to use. So here's an example of how this will work. At WWDC, they demoed this particular use case. So a person could ask their phone when it was time to pick up their mom from the airport. So the phone, with your consent, will look up the flight number for your mom, and she shared that with you in a recent email or a text message. So Apple Intelligence will look up your mom's flight number. It will start tracking the route for her flight. It will analyze traffic patterns, air traffic patterns, including her own particular flight. And it will tell you, based on traffic patterns within your city where you're located, it will tell you when it was time to leave for the airport so that you arrive to pick her up on time. And it will also provide the best map route for you to get to the airport on time. And all of these actions will be accomplished. All of these actions will be completed based on one voice command that you give Siri. Some other productivity use cases that they showcased were assistive writing of messages and emails, including grammar and spelling and sentence structure, and even tone changes, by the way. So you could change the tone of your message. You could ask the AI engine to change the tone of your message, and it would rewrite that entire message in a grammatically correct and a correctly spelled with the right sentence structure, etc. You could also use Apple Intelligence to automatically summarize multiple emails from the same sender so that it provides you with a summary of all of the key pertinent information that you need to know. You could also complete tasks by searching through email history, message history, and even lookups using Siri's search engine. So what Apple is introducing is a seamless Apple-branded artificial intelligence experience in the form of a supercharged Siri. Now, this has been a long time overdue. I mean, currently it seems that Apple Intelligence will only work on Apple native apps, but it should soon extend. It will soon be extended to other apps, third-party developer apps, because Apple is making these AI APIs available to developers to allow them to use API capabilities within their own apps. This has been a long overdue development and announcement by Apple. I'm personally very excited to see how these AI features will work. I have to upgrade my iPhone 13 mini so that I can use them. And so I'm going to be one of those users that will upgrade my iPhone sometime in September when the new iPhones come out. I'm also planning a small test of sorts. For 1 week, I'm going to try this. For 1 week, I'm going to try to use my new iPhone with the new iOS 18 only using voice commands. I'm only going to use my hands to pick up the phone when I need to physically move the phone. I will only use voice commands to do everything that I would typically do using the iPhone, and let's see how it works. I'll report back on my experience. Now, for the geeks in us, how does all this Apple Intelligence work? How will the new Siri work? Well, Amrita Roy from The Pragmatic Optimist, she wrote an excellent post this week on the details of these Apple AI announcements, as well as how this will work. In fact, Amrita, in her last 3 to 4 posts, has been very much on point regarding AI and tech developments. I recommend that you subscribe to her Substack and get into the habit of reading her stuff. Amrita writes some fantastic content. She's a very talented writer, and she always gives me food for thought that I believe makes me a better investor. So back to the question at hand. So for the geeks in us, how does all this Apple Intelligence work? How will the new Siri work? Well, there's already a lot of data on our device, right? In our contacts list, on our calendar, in our emails and messages, our usage habits, the daily alarms that we set, the reminders, our to-do lists, our notes, notepads, etc. So Siri can look up all of this information when needed. And it can also find, Siri can also find new, Siri's getting better at finding information online as well when needed. So the new Siri, when responding to a new user request in the form of an action or information that's been requested, the new Siri will look up the personal context that is available on the device. She will look up the state of user interaction within the apps that are running on the device at that time, and she will look at what we've been doing within these various apps at any point in time. Then the new intent APIs that comes with the iOS 18 operating system. So these intent APIs are the new AI APIs that Apple is introducing. These intent APIs will, along with Siri, use what's called a semantic index function that organizes and connects all of this contextual data that it has collected about us. It organizes this data, it refers to this data, it gathers more data and constantly updates this semantic index. And then it completes the action that the user has requested based on what it finds within the semantic index. Apple Intelligence will also offer the user options to improve the output or go deeper into an action by asking a follow-up question or offering a follow-up set of actions. As we saw in the use case we discussed earlier, where we're asking for when we should pick up our mom from the airport, but it also gives you a variety of other actions with respect to traveling to the airport or even following up actions after you pick up your mom from the airport. And all of this is done on the device in a secure manner. This on-device AI action is completed by Apple's AI models that will be aware of your personal data without collecting it, without storing it, and using it like almost all other AI models do today. Remember, last week I told you a few anecdotes of professionals that I know that are not allowed to use ChatGPT on their corporate laptops because their companies are afraid that these co-pilots will inadvertently access and store and use corporate business data. Well, this week I met up with some other buddies, and all of them happen to be developers. This week I learned from that same group of developer friends that several other industries are doing the same thing, are placing similar restrictions. These friends that I met this week were from industries like healthcare, banking, insurance, and even marketing. And all of them, literally all of them, confirmed that co-pilots are not allowed for use in their work laptops today. They only use co-pilots in limited situations to develop code to do software programming, and they are isolated away from corporate business data. So in the case of the consumer, Apple is being very careful to stick within the trusted guardrails that its consumers expect it to function. The Apple AI model only accesses the necessary context that it needs to deliver a specific answer or to complete the user request. The data is not stored by Apple on a backend server or in the cloud. If AI requests need a little bit more juice, Apple offers two options. One, they've created a private AI Apple Cloud that has additional AI processing power in case the AI model on the user's phone needs a bit more processing power. Apple's private cloud will take up that query and respond to it, and then it will delete all user data that it has used to respond to process that AI query. The second option is users are also given, like I said previously, in some situations, users are given the option to use OpenAI's ChatGPT for further lookup and further AI processing. And this is done with the user's permission. And again, ChatGPT in this case is not allowed to store any user data or history, again, providing the user with a branded, trusted AI experience. All these cloud-based processing architectures will be monitored and verified by third parties for compliance with Apple Intelligence's privacy and security guardrails. So Apple Intelligence will utilize a combination of on-device as well as cloud-based processing, depending on the complexity of the task as well as on the privacy considerations in place. Tasks requiring immediate results and high data privacy will be processed on-device using the device's processing power and ensuring that sensitive data remains secure. More complex tasks requiring higher computational resources, such as advanced natural language processing, intricate analysis, complex image and video generation, etc., those can be offloaded to Apple's private cloud or to OpenAI's cloud if the user so desires and permits them to do. Now, Apple is the most admired brand in the world, and their products are widely sought today in spite of their typically higher prices. You got phones and MacBooks and laptops, iPads, AirPods, Visual Pro, streaming TV, automobile service, the App Store, etc. And the list keeps growing. Each of these segments are large enough to compete as separate Fortune 500 companies in their own right. Like I said, they have a global install base of over 2.2 billion devices. This includes 1.5 billion iPhone users and a leading 29% market share. By the way, they overtook Samsung in Q4 2023 to be the leading smartphone provider in the world. They currently have more than 1 billion paid subscriptions for their services. Their services business has been increasing at a 27% compounded annual growth rate. It's been up by more than 150 million new subscriptions just over the last 12 months. It has doubled over the last 4 years and 5x'd over the last 10 years, their subscription business. Now, Apple device sales have been lumpy over the past year as consumers have held off on upgrading their iPhones and their iPads and MacBook computers. Apple has not really given them enough of juice. It hasn't really given them strong enough reasons to upgrade. And Apple has had a lot of ground to cover when it comes to embedding AI into their product line. Well, this February, I posed this question to my readers. I wrote this in February. I posed them this question: can Apple become an AI winner? So let's take measure of what's needed to be successful in AI. You need 5 things in my book. One, you need capital to build and rent computing infrastructure. 2, you need globs of data to train those AI models, those AI LLMs, MLMs, and SLMs. 3, you need smart engineering and data science talent. 4, you need a massive customer base to test those AI solutions. And 5, you need a massive customer base to buy those AI solutions. So in Apple's case, Apple has all of these 5 things and more. In fact, I would argue that Apple has major advantages across these 5 dimensions as compared to any of their competitors, with the exception of perhaps Google when it comes to having more consumer data, and Meta when it comes to having more users. Now consider this possibility. Remember, I wrote this in February. In February, I asked my readers to consider the possibility that Apple develops a generative AI-driven, better, more sophisticated Siri personal agent. This supercharged Siri Plus is then infused into their iOS operating system for all their devices. Siri Plus is then included as part of a recently higher priced Apple One subscription package and only works on the new devices. And then Siri Plus is also part of the next generation CarPlay automobile software, providing better driver support, better mapping, navigation, en route searches, voice commands, music control, lighting control, etc. Well, this week's Apple's announcements regarding their software and AI upgrades coming to all of their devices in September is an attempt, in my mind, to address this very vision that I discussed in February and to stimulate a new product upgrade wave. It remains to be seen whether this will actually happen, but Wall Street seems to think that yes, it will happen. As per a very large Bank of America survey, 77% of iPhone owners in the US today own older iPhones in the iPhone 11, iPhone 12, and iPhone 13 category. I am one of them. I own an iPhone 13 mini. So 77% of US-based iPhone owners own older devices. And these old phones will be 3 to 5 years old this winter, Q4 2024. And they are not going to be able to benefit from all of these new AI features. So the thinking is that these iPhone users will start upgrading their devices starting in Q4 2024. And this upgrade cycle will play out in waves for the next 2 to 3 years, bringing in new incremental revenue to Apple, along with higher profits and more cash flows, and further expanding their global smart device and consumer AI footprint. Apple has the potential to come out on top as a significant beneficiary of AI, given that they seem to have something that no other company in the world can offer: an integrated device plus software plus a services ecosystem that has privacy at its core, as a trusted consumer brand, as a strong trusted consumer brand with privacy at its core, and now powered by AI. That, to me, my friends, is a winning combination that investors and markets should pay attention to. Apple's approach to AI emphasizes seamless integration into their applications. It prioritizes user-friendly experiences over flashy generative AI capabilities. Now, on the negative side, we have to talk about what are the risks here. On the negative side, Apple, for now at least, seems to be dependent on third parties like OpenAI and Google for their AI capabilities. So the question at hand is, will Apple lose control of their AI destiny? Well, Gene Munster, he's a Twitter handle that I follow. Gene Munster wrote about this very discussion point recently. Gene said that the reality is that the most exciting parts of Apple's AI-driven features will be powered by third parties, likely for the next 2 to 3 years. This was the right decision for Apple to take to make up for lost time. Secondly, Gene says that in terms of economics, we do not know who is paying whom in this new partnership. Is Apple paying OpenAI to use their ChatGPT AI engine or the vice versa? Today, we know, for example, that Google pays Apple about $15 to $20 billion per year for Google to be the default search engine on all Apple devices. So maybe OpenAI has signed a similar deal with Apple, where OpenAI is paying Apple to be the AI engine of choice that is offered up to users. We don't know, but we'll find out about the economics soon enough. And the third point Gene says is that eventually Apple will accelerate development of its own models. Apple has what it's called the Ajax model, and Gene believes that Apple will accelerate development of their own models, and it will start providing Ajax as an AI engine of choice to users on their devices. And over time, 3 years plus, Apple will come out with its own foundational generative AI model that could replace these third-party models at some point. Today, it seems that most consumers are very tentative and unsure about the impact of AI to their lives, to their jobs, and to their privacy. I mean, we've seen enough of Hollywood movies in which the robots go wild and start attacking humans and take over the world. But Apple commands one of the most admired and highly trusted brands today. Consumers love Apple products, and to a large extent, they trust the security and privacy that is built into their iPhone, their iPad, and their iWatch. If anyone can get AI for the consumer right, it is Apple. Now, as an investor, so let's put on our investor hat. As an investor, how should we think about all these developments this week? Well, one, in the short term, we want to see Apple device sales pick up in Q4 this year and beyond. We want to see that the recent negative sales growth trend is reversing and it's going higher and going positive. This is now a two-horse consumer AI race between Apple with 2.2 billion iOS devices and Google, which sports 3 billion Android devices in the world today. Remember, the Android devices are typically sold by companies like Samsung. Well, Google sells their own phones as well. But Samsung is the biggest smartphone competitor to Apple today. And it is now a two-horse race in the consumer AI space between Apple devices and Google or Samsung devices. So that's in the short term. We want to see sales increase and we want to see sales growth go positive. In the medium term, we want to continue to see Apple releasing new AI enhancements. We want to see new AI app integration. We want to see more third-party AI apps coming onto the App Store, and we want to see AI integration seamlessly working across these new third-party apps as well as Apple's native apps. And perhaps we also, as an investor, we also want to see new Apple service offerings that are going to be powered by AI. We want to see service offerings that will generate new AI-related revenues for Apple. Services today are about 26% of Apple's total revenues, and they sport a very high, a very, very profitable 75% gross margin. So you bet that Apple is thinking up some new AI-driven services that they can start selling to their massive user base. And this is exactly what we as investors want to see in the medium term. And then in the long term, Apple could bring AI further into people's daily lives and truly become the de facto consumer-facing AI leader as it brings these Apple AI capabilities to Apple Home, Apple TV, and perhaps even the Apple CarPlay experience that we use in our cars today. The next huge frontier for Apple could be a multi-trillion-dollar opportunity in autonomous vehicles. So is Apple stock a buy now? Well, that is exactly what I'm trying to figure out, actively trying to figure out with my fellow readers today. This week's developments have given us a lot of food for thought as to these questions that investors in Apple or investors that are considering Apple as a stock holding in their portfolio. These developments this week have given us a lot of good food for thought. So more to come on this space. Stay tuned. And what's coming up in the markets over the next 2 weeks? Well, I think it's going to be a couple of quiet 2 weeks in the markets, except for a little bit of volatility. On June 19th, we have to remember that markets are going to be closed for Juneteenth, National Independence Day. And then on Friday, June 21st, we have a very large monthly options expiration. And then next Friday, June 28th, will be a very large quad-witch quarterly options expiration. So those are the two volatility-related events that are coming up in the markets, but nothing else major in terms of macro updates or events. Maybe a bunch of Fed speeches. Yeah, they're going to go on the speaking circuit now that their meeting is done. So markets might get moved up and down based on that. But relatively speaking, it should be a quiet 2 weeks. This will give me a chance to catch up on my own analysis and research in my writing. So I'm really looking forward to it. So that's all I have for this episode of Market Whispers. Remember to hit the like button if you've enjoyed this episode. Drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest. For life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.